Hello guys, moving on with our Binary Options Academy project, trading double combinations. And this is double combinations, and this is the second part of our project here. On the first part, we laid down the rules of what a double combination is, how it looks like. It is being formed actually out of two different corrective waves. This will be the first corrective wave, A, B, C, and then of course the X wave, and then it ends with contracting triangle or another zigzag if the first corrective move was a flat. Why? Because if the second corrective move here was again a flat, so this to be a flat, the X wave, and another flat, the pattern would be called a double flat. And combinations basically represents just different combinations, if you want, possibilities to combine different corrective ways based on to be connected with an X wave. What's extremely important here is that the X wave here, which can be any corrective pattern on its own, I mean another contracting triangle or another flat or another zigzag, not to retrace more than 61.8% when compared with the previous ABC. So I would like to show you an example, and the classical example is the recent move that the US dollar Japanese yen pair made from the highs here, the highs in the 105.30 level, and all these move to the downside. See, these are current prices here around 102, and this move here to the downside, I would like to try to look at it. Well, first of all, we have a three-way structure, as you can see here, this being a wave A and the B and the C. Then I would say that this would be only our first three-way structure for wave A. Then we have a B wave that goes all the way to the upside, and the B wave goes and actually retraces more than 61.8 when compared with the previous wave A here. That makes it valid for a flat, and from that moment on we are looking at a different five-way structure to the downside to form our C wave here. So A, B, C, and I would say that the first correction here, so this correction here, is completed, and the first correction being called a flat, so this would be our flat here. From here to here, the ABC is completed. Then we need an X wave, and what's important here is for the X wave to be not to retrace more than 61.8 when compared with the whole corrective wave here. So we need to have Fibonacci, but this is visible with the open eye that market is not retracing more than 61.8. But instead, for the X wave, which can be any corrective pattern, it forms a contracting triangle, A, B, C, D, E. So our X wave here can be a flat, can be a zigzag, can be a triangle. It turns out it is a triangle. So our X wave here is a contracting triangle like this. So what do we have? Well, we have the first corrective wave, we have the X wave, and then we know that in most of the cases, well, we need another corrective wave, and something like 85%, 90% of the time, that last corrective wave is a contracting triangle. So we want to actually go and engage into buying call options when every time price goes below the lows in the previous C wave. So this is how we are trading actually such a pattern. Every time market goes, in the theory, below this moment of time, we want to buy call options. So we would just take this area here, any projected on the right side, the same area here on our example here. So every time market goes here, we want to go and buy call options, because our triangle to the downside now goes like this. Wave A being here, then the B wave all the way here, then the C wave to the downside, then the D wave like this, and of course the E wave. So A, B, C, D, E, And just like that, what do we have here? We have a contract in triangle. We should make it in blue, like it is the example above. And we want to go and buy call options every time price come into this area of the previous low that is being made with this move lower. So we want to buy call options there. We want to buy call options here as well when the market breaks as well. We want to buy call options, if you want, every time. If you project that moment of time, will be a nice support for every time price comes into that direction. Expiration date should be different based on the time frame that we have there. And I would say a nice expiration date for such a 4-hour chart would be end of week expiration date, or even end of day if you are more aggressive. But depends very much on the moment during the trading day this is happening. Well, this is how to trade a double combination with a binary option. Thank you for being here. Binary Options Academy projects, and all these projects and analyses are possible due to the help of our sponsor, Lioneye. Bye bye.